Go ahead and start recording. And we will give a few minutes to kind of let everybody filter in and get their audio set. And then we will get rolling. Erik, can you see my screen okay on that?
I can.
Perfect. Okay. We are going to go ahead and get rolling. So for those of you who I haven't had an opportunity to get to know personally, my name is Katie Anderson. I am one of the owners here at Aperion, and I'm joined today by Erik Robinson. I'll let him go ahead and introduce himself.
Good afternoon, everyone. Thanks for joining us. My name is Erik Robinson. I'm the Director of Community Management for Aperion, and I've worked with Katie and for Aperion for about 10 years. And administered this training last year with a fellow senior community manager, Mindy Miranda, and I'm happy to be joined by our CEO, Katie, today.
Yeah. So this training is pretty timely. We're going to talk about budgets as we head into budget season. So thank you so much for giving us about an hour of your time. Erik and I will try to be as good stewards with that as we can and kind of move through content and give you an opportunity for questions at the end. This training is really meant to be sort of generic in its nature, because we do cover a wide variety of client types. So, if you're a condominium or you're a single family, you are, a leasehold or other things like that, you might have different nuances to how this, how your budget gets established or structured or what you're responsible for. So our goal today is to kind of give you, a foundation for what is your budget, what can you expect as far as a schedule and the process of how we move through development of these documents and adoption of them. We're going to go through some sort of budget overviews, some key strategies to keep in mind around that piece. And then again, we're going to give you guys an opportunity at the end to ask some questions. We'll try to be, Erik and I will try to answer what we can if there's specifics for your community that we might need to loop your manager in and follow up with you on, but we will give some time at the end to address any questions or concerns that you might have. So what is your budget? Hopefully most of you on this call kind of have a foundation for this, but your budget, is really a tool that both the management company and your board is responsible that there is enough funds being collected and allocated through assessments or maintenance fees in a manner that maintains or increases the financial and physical health of your community. So all of your documents are going to establish a baseline for what you are responsible to take care of. And there's frequently going to be provisions in there that talk about what the association needs to maintain and what the obligations are of the community. And from that, then develops this framework for those expenses. And there are some nuances to that. Erik and I are going to go through that today. Some of those things are kind of hard and fast as far as what you do and do not, what you can and cannot do. Some of those things have a little bit more flexibility as far as desires of the community or things that the community may want to accomplish, so there is some flexibility around how those things potentially get developed. But at its core, your assessments and your maintenance fees are helping to improve the financial and physical health of the community, making sure that you are maintaining that long-term strategy as well as short-term maintenance. So an example of what your budget is going to look like. If this is your first year being a part of Aperion, the document that we're going to prepare for you in the initial draft may look a little different than what you're used to. It might, maybe you had singular columns as far as annual totals in the past. We prefer, when it makes sense for the community, to really set this up as a 12-month seasonal budget. So you're going to see your GL or your account numbers that line up with your general ledger accounting structure over on the left-hand side of that screen. And you're going to see then the categories that aligns with. You're going to the budget's going to be broken out into the same sections that line up with your income statement. So we're going to have your income, your expense categories, and then that net at the bottom. It's going to then move across, January to December and provide you with the totals. So the perspective of this is to give you a really good idea of when that income's coming in, when the expenses are going out, and sort of true that up every year. So we're not just taking last year's numbers and applying this sort of fixed, CPI increase to it. We do sit and sort of go through these expense line items. The management team has been working on this, over the last month to 6 weeks, and Erik's going to kind of talk about the schedule. But we want to look at every one of these expense categories on an annual basis and make sure, do the numbers still make sense? Where are we at on power usage? What is the increase for next year? Are we budgeting enough for that? And so each of these line items is looked at by the management team. You will see also in your template, you will see that we're pulling in year-to-date numbers in there as well, sort of as a metric and a guidance on there. This particular slide is a little more basic and doesn't have that in there, but you're also going to see your year-to-date numbers that are pulled into this report. So you're not kind of having to go back and forth between the draft budget and those documents. So that's what the basic format of what the document looks like. Erik, I'm going to turn over to Erik, and Erik's going to share a little bit about now how this process is going to work.
Thanks, Katie. That was a great introduction. And I'm going to jump in and talk a little bit about the nuts and bolts and the timeline and the flow of how the budget comes about, and what role the board and management kind of takes in each of these steps that you see on your screen. Believe it or not, and every year, again, I've been doing this for 10 years, not quite as long as Katie, but every year it's like hard to wrap my mind around the fact that this work needs to start in August, which of course is, many months before the end of your current fiscal year. And if you're a board member in a community, that August is, a very difficult time to be handling much of anything aside from, teenagers throwing furniture in your pool, or the weeds not getting pulled in all the landscape beds, or whatever it is during the summer. But the preparation work for a budget does start in August, and the reason for that is because if there is any desire for the board of directors to put their annual business contracts, their annual service vendors out to bid for the next fiscal year. So say, you're dissatisfied with the landscaping, or, the board has a bidding policy where they need to put those things out to bid, every year, every few years. That work takes place in August generally, because you need to get the RFPs prepared. You need to get that information out to people that you want to bid on your service. And then you need to get those numbers back, because in order to draft the most accurate budget, you're going to need to know what those costs are going to be for the next fiscal year. So basically, we're talking about, landscaping, pool, any custodial, if you have a clubhouse or something like that. Those kinds of things start in August. And of course, as Katie pointed out in the chat, there are some communities that may have different fiscal year timeframes. But for the purposes of the general presentation, we're just going for January to December on this timeline right here. So that work's going to start about August 1st. And of course, the management needs communication from the board that, they do or they do not want different contracts to go out to bid during that time frame. So then about August 15th, right, you're soliciting your business partners. If you're not putting things out to bid, and you just want to know, from your landscaper, from your pool contractor, what those numbers that they're projecting for their maintenance contracts for the following year are going to be, you want to get that information as soon as possible. Now, in August, those vendors are as busy as management and board volunteers and committee volunteers are, right? They're still taking care of the landscape. They're still taking care of the pool. So sometimes we have to be pretty persistent to get new numbers out of them. But usually when you stress the fact that you have to adhere to this timeline, because as we'll see later in it, there's a requirement to get those numbers to the association members 30 days ahead of time before the new fiscal year kicks in. When you're persistent, generally your business partners are going to come up with some kind of proposal for the following year. So then you can get to September 1st, which is when you're going to start drafting that first round of your next fiscal year's budget. So just talking again in generalities, generally your manager at Aperion Management Group is going to be drafting that first budget. And I'll talk a little bit more in the next slide about the strategies and how those numbers are put together. But this is the point. If the board has any specific direction or goals or changes that they want to see in the budget for the next year, this is about the time that you want to make sure that the manager knows what those directions are. Whether it's, we want to add preventative pest control service next year, or we want to, make sure we have extra money for building maintenance repairs because we know there's some siding work that's going to need to be done and it's not reflected in the reserve study, or it could be a number of things. But communication with your manager, in between your manager and the board during this time on really what are the goals of the board for the next fiscal year is important to be communicated. So then we're moving to September, October, and November, which is when the manager is going to be finalizing the draft budget. The board's going to hold the budget meeting, and they're going to approve that budget for the next fiscal year. And that's a big time frame. And the reason for that is because, as portfolio managers at Aperion, say a manager has 7 communities, they have 7 budget meetings that they need to prepare budgets for, plan, notice, and execute in about a 6-week time frame during those months. So we spread them out as much as possible so the manager can, really focus and make sure that they're getting checking all the boxes for the board and for that budget before they move on to the next meeting. Now, in this portion right here, September, October, November, ideally, the manager is going to finish a first draft of the budget. They're going to get together with someone on the board, not the whole board, because we don't want to have a quorum in a meeting, just maybe the treasurer typically, and go over that draft budget and make any changes that need to be made. Because then the idea is we want our boards to walk into the budget meeting without any surprises. So every manager for the budget is going to put together a budget assumptions worksheet. It's going to highlight exactly what the changes were to the new draft budget. And they're going to provide all that ahead of time to the rest of the board members, typically with the treasurer's blessing. And so everyone walks into the board meeting with a good understanding of what that budget looks like and is ready to approve it. Hopefully there's not a whole lot of, revising or finagling of the budget numbers that has to happen in the meeting. It's kind of like painting, like all the prep work is done. And then it's just like, you just got to put the paint on the wall. Now, once you've approved that budget, that's going to get emailed and hard mailed to all the owners. And as I talked about before, in Oregon, budgets have to be received by the owners within 30 days of the fiscal year end. So December 1st, all those emails and all those mailings need to be completed for every client on a regular fiscal year, because January 1st, the new fiscal year starts. You can go to the next slide, Katie. So I'm going to talk a little bit about the drafting process. Katie touched on this a little bit to start, but the drafting process is taking a lot of different streams of information and a lot of history and putting it all together with your best guess and projections of what's going to happen in the next year. So it's really a mixture of historical data, contract term projection, increases in that manner, any increases that are known to utilities. So this, I know last year was a really big one for a lot of our clients because there was some very significant increases in a few utilities, up to 25%, I think. And if we hadn't, called the utility commissions and called every utility provider for all of our association clients, we could have missed the mark by quite a lot on drafting those utility numbers. And then, of course, taking into account the goals of the board for the next budget. Now, the next piece is really important. So it's net zero goal. So bottom line, the assessments should meet the projected expenses for the next year. So this is something that owners don't usually like to hear or like to see, but it's the board's duty and management's duty to project those expenses as best they can and to calculate the assessments to meet those expenses. Not to go over those expenses. You can't budget as an association for any profit. You're just trying to go to a net zero. So your income equals your expenses. The thing that your owners don't like is that, costs go up every year, which means, as managers, like, our expectation is every assessment is going to go up at least by a small percentage every single year, because the association's costs always go up every single year. The next bullet talks about a 12-month budget expenses versus monthly projections. And back to the example budget, Katie talked about this a little bit, but I wanted to give a little bit more detail on what we're talking about. So at Aperion, we draft our budgets so that the expenses are budgeted in the month that we expect them to occur. So, not every month are you doing snow removal. Not every month are you necessarily paying your pool contractor or your landscape contractor, depending on those contract terms. So when you budget for when the expense is supposed to hit for that month, you're going to get a more accurate picture of where your cash flow is and where your variances are year to date, as opposed to just taking an annual amount. Say, we know we're going to pay our landscape contractor, $12,000 for the year. So we're just going to put $1,000 in every month, even though they're only charging for 6 months when they're working. That can really skew your budget comparison report and show, in March, you're $3,000 under budget on landscaping, but that's not really accurate because landscaping expenses haven't actually started until, April or May. So that's the reason that we try and do that. And we do that, again, based on pulling the actual numbers that have been spent over the last several years and in what month they're spent, and using that to draft that budget. Another piece of the budget, of course, is your reserve contributions. And there's another slide. I'll talk a little bit more about this, but reserve contributions are based on the funding model in your reserve study. And it's going to have, in a mathematical algorithm that tells you how much every year your reserve contributions for future reserve projects need to rise. They base that on inflation and the assets, the timelines, and the projected cost of all of those projects that are in your reserve study. And the last piece that is taken into account when drafting these budgets is ensuring that the board and the manager all have a really good understanding of how assessments are calculated. Over 10 years, I've seen a whole lot of different ways that this happens. There's communities that have different assessments for insurance based on the square footage of a condo unit, because that condo unit's smaller, it doesn't pay as much in insurance because it's not, insuring as large a part of the building. There could be caveats in your governing documents for, if you're like a single family community, but maybe there's some alleys that have people's garages and homes are part of that. And they may pay a little bit extra for maintenance of that specific area in the community. I manage a mixed-use commercial residential project that splits every expense between those two entities. It can get kind of complicated, but generally all that information is going to be found in the governing documents of the association, in the exhibits, and ensuring that the assessments are being calculated properly based on those breakdowns is obviously critical to making sure that your budget is accurate. Next slide. And this, again, is a big part of the process. So what's trending? Reviewing the last 5 years of budgets is fairly standard, and looking for the trends in those pieces. So we don't want to, we're human, the board's human. There's been times where a budget's been passed after it's been through 10 sets of eyes where a mistake was there. You didn't budget for one particular thing. By going back 5 years and looking at the history of those budgets, you can get a really good idea of where you're hitting and where you're missing by looking at those trends. Maybe you notice that every year, this association is $2,000 to $5,000 over budget on building maintenance or irrigation repairs. Or maybe you notice, 3 years ago, there was very little in irrigation repairs, but in the last 2 years, there's been a whole lot. So, looking at that stuff and again, just doing your best to project what you really think that's what it's going to be the next year. And that might involve phone calls to the landscaper, to the people on the ground doing the work in the association to figure out where things are trending, where costs are going. Maybe I think it was a couple years ago, there was a huge increase in pool chemicals. And so that's something that, you want to talk to your pool contractor about, and you want to make sure you address in your budget numbers. So this in front of you is a whole lot of numbers, but if you're a board member and you've looked at a reserve study, you're probably going to see a table like this. So when I talk about reserve contributions, this is the kind of table your manager and the board members are looking at when you're talking about drafting your budget for the next year. So the beginning balance up there is, is reflecting whatever that balance is when the reserve study was drafted. And of course, the reserve study is a dynamic document, so it's being updated and with new figures and known cost of projects or updated costs of construction or whatever it is, usually every year, every 2 years. But you can see on the left is the year. Next to that is the annual contribution. So that is what the manager is looking at when they're determining what the reserve contribution for that particular year is going to be. The other ones are expenditures. So, at a quick glance, you can see in this particular model, 2024 and 2031 have the highest expenses. So looking forward, prudent financial planning is going to say, like, we need to make sure that our contributions leading up to those years are going to be sufficient to cover the projects that are happening during that time frame. Projected ending reserves, fully funded reserves, percent funded. That's talking about there's different models for funding reserve accounts. Fully funded, threshold funding, baseline funding, but that's kind of a different training. We're not going to get into that today. Suffice it to say, examination of upcoming projects and the reserve funding is a key part of budget planning. And I did want to address one other thing, I think, before I'm handing it back to Katie here. we often get asked by our boards about reserve budgets. You know, do you have a reserve budget? What are we going to spend in reserves this year? And I'll explain it here, and I'm sure we'll explain it a bunch of other times over the course of the budget season. But there is no reserve budget that we lay out for the fiscal year. It's contributions, and then you track the expenses throughout the year. And the reason for that is because reserve projects and reserve items are somewhat unpredictable on when they're actually going to be needed. So, you know, your reserve study may say in the middle of 2024, we're going to need to buy a new pool heater for $9,000. Well, maybe, or maybe your pool contractor says, you know what, this thing's going to last another 5 years. You don't need to do that. And you don't always have all those answers before you get into the year. And then, of course, other things might blow up 3 or 4 years early. So trying to plan exactly what your reserve budget in that year is going to be would be a really difficult thing to target. It's a moving target full of elements of your community that are supposed to last for a long time. So we just have, you know, this is how much is going to be contributed. And then at any time during the year, of course, we can print out, you know, a ledger or break down for the board exactly what the reserve expenses have been for that year. But that's why updating your study frequently is also important.
Yeah, because as Erik said, it's a really dynamic piece that sort of fluctuates. Just because it's in the study doesn't necessarily mean that you're spending those funds or you can't move that or adjust it to another year. So it's why we look at the reserves every year. And the important piece of the component is to understand sort of the difference in the buckets that we place maintenance versus reserves. And maintenance, you know, is a little bit more manageable for the association, but it's the critical component to make sure that you're achieving the useful lives that are noted in your reserve study. So obviously the slide we had before this is a single snapshot or a single slide within a really dynamic report that is going to provide you with a lot of information about your components. If you haven't taken a look at your reserve study, we would encourage you to. As Erik said, that's another training. You can visit our YouTube channel. I think Karen from Association Reserves did a great reserve study training for us last year that's recorded, and it's up on our YouTube channel if you want a deeper dive into understanding reserves. But the piece of it that's really important to understand is how we then take that information and translate it into your financial tools, right? So you have a few tools in your tool chest. You have your reserve study, which is one component. It's that long range financial planning tool for you. And then you have your maintenance sort of plan or your maintenance objectives, right? What do we need to do to those components to ensure that we get the useful life out of it? And both of those things then translate into the numbers in the budget. If we know we need to clean your gutters, 3 times a year to keep your roof clean and keep, the optimal useful life of the shingles that you're going to have to replace in 30 years, then we know that that work has to take place operationally within your budget. And then you have your longer range planning tools within the reserve study. So keeping those maintenance items, well documented into the operational expenses means that you are taking care and repairing those items before they become a problem or they degrade and you don't get the useful life that you want out of them, right? So there's this balance between making sure that we're accomplishing the maintenance necessary on those items. And when is it time for us to sort of cut our losses on that and replace it because we've gotten the optimal useful life out of it and the overall maintenance cost of it is now costing us more than if we replaced it with the latest, technology or piece of equipment. A lot of times we see it, it can lower energy costs, it can lower chemical costs, especially around pools. you want to be looking at pool heaters and sand filters and those types of things in regular succession. And so having an understanding as to what bucket those expenses are getting placed into is really helpful when you're going in to then review the budget and know where those line items are being paid for. You may have a singular line in your budget that says exterior building maintenance. That exterior building maintenance may encompass a handful of things that have to happen throughout the year in order to make sure that your reserve component gets the best life out of it. So there may be pressure washing or window cleaning or gutter cleaning. You might have, sidewalk clearing or light bulbs, those types of things. So it depends on how granular your expenses get in your general ledger. Some communities are tracking, electrical expenses and plumbing expenses and, roof repairs, those types of things separate. Some of it's all going to be in one bucket. And then you're going to see sort of in the notes section of your budget, a more detail of what's comprising that, so there may be several then vendor contracts that are a part of that maintenance item. But the maintenance is really anything that happens in that 12-month calendar period in order to maintain that common element. And your reserve contribution, or the money you spend out of your reserves, is going to be anything that you're doing from sort of 2 to 30 years. So if you're doing something every single year, bark replacement sometimes is one that gets, sort of tossed in to the reserves. And there's no hard and fast rule that says you can't have something that happens every single year happen in the reserves. But best practice is generally that anything that happens in an annual succession, that it's in your operating budget, and that if it's less frequent than that, it's happening in your reserves. And part of that is so you don't lose track of those expenses. So understand kind of where those buckets lie. Now, there is flexibility in how the board sort of determines these things, but this is the general rule of thumb of how our managers are going to approach this. And generally speaking, when they make recommendations to you on completing work and where those funds get paid from, it's going to align with this. So they're going to be coming to you and saying, based off of where we have budgeted this is what I would recommend that the board approve. And then it comes out of your operating dollars or it comes out of your reserves. Now, your reserve study, as Erik mentioned, is going to give you the detail of what those annual expenses look like. So back on that prior slide, when you look at this annual expenditure category, most of those reports, if you go, dig in, it's going to tell you exactly what we expect, what makes up that $262,000 number as far as the projects that are anticipated. And those things will be presented to the board during the budget process as far as here's the things that are upcoming that we're doing some due diligence on, and we'll bring final recommendations. But as Erik mentioned, there's not going to be a separate budget that comprises this number, because the number that goes into your budget on that is going to be that contribution number. And then your maintenance numbers are going to be comprised of those expense categories that are taking care of those common elements. So it's really important this time of year that, the board have some real strategic conversations as well on how you are allocating your dollars and, sort of finding long-term projects that have that positive ROI to it. I mentioned pools. I think pools are a great, if you have a pool, it's a great way for your board to make sure, do we have the most effective and efficient system? Is our pump running all the time because the system is outdated and it's putting a lot of stress on the equipment? Could we put a more efficient system that's, creates a better ROI for us, as well as provides a better experience for the owners? Landscape's a tricky one. We probably could do we have done a whole other training on landscaping, but landscaping is really tricky. I think, anything that has a significant impact, be a significant impact on wage right now, or the overall, employment sector impacts, is really tricky right now, because any of those areas where you've seen large increases in wages, we have some fluctuation in those costs. So making sure, is there ways for us to align the service to meet the overall goal for the community. Looking at things like Energy Trust of Oregon, as far as opportunities, Eric's mentioning in the chat, there's opportunities to switch out to LED fixtures. There's credits and rebates on some of those. We have some larger reserve projects. There are some opportunities for some energy credits. They've gotten a little less over the last couple of years, but looking at ways that we could reduce water, reduce electricity, and be more efficient is definitely something that across the state, across all of our clients, that we're trying to take a look at and see if there are ways for us to accomplish those goals for the community. So I think that when it comes to budget and it comes to assessment planning for a community, it's probably one of the trickiest conversations that our managers navigate. If you know us or know our managers, we certainly like to poke fun at ourselves, and we hope that none of your treasurers or boards are playing the lottery with your guys' money. That wouldn't be something that we would support if you're a client of ours, but we certainly want to make sure that the budgets we're putting in front of you always take a realistic look at the funding that's necessary to accomplish what you need. And so we're not necessarily going to look at it through the lens of where that end number needs to line up. Our managers are going to look at it from the perspective of what are the expenses that we need to meet to achieve the obligations of the community, as well as the long-term funding strategies. And so that first draft budget that we put in front of you, if you have some funding challenges, can be kind of tricky, especially if you've got a scenario where you need to raise reserves, or you have some maintenance expenses that are, increasing, your landscaper is going up significantly. That first initial draft budget can kind of be a bit of a, oh man, do we need to go up 10% or 15%, those things. And so it's really important that when we look at that first budget, that we don't start with an idea in mind of where you need to land from a funding perspective, because we're building your expenses first. And then, as Erik said, it's a zero-sum game, right? So we're building your expenses first, and then your income is going to match that. So that is then when it gets tricky for you as board members to then be analyzing this and understand that sometimes that means that you got to increase assessments in order to meet those obligations. And that is a hard conversation to have if, either historically you haven't increased assessments, or maybe you haven't kept pace with the reserves, or various things that may be playing into that. There's a lot of scenarios that we encounter for clients as to, why they may be in a position where the assessments don't quite meet the obligations for the community. And so I would just encourage you as board members to be open-minded as you go into this budget process. Try not to get sort of dead set or locked in on the overall increase. That is a part of what, we're looking at and examining. You may have provisions in your documents that prevent assessments from going up too much. And so, there's definitely some balancing for communities that have those types of provisions, but understand our manager's goal is to put a very realistic budget in front of you as that first initial draft, and not try to pad it too much or be unrealistic, but that's the lens they're looking at it. They're not necessarily saying like, we got to keep assessments at 5%, so let's back into that number, because that will definitely leave you in a scenario where you aren't meeting the obligations. And this is kind of a funny comic, but Erik's been doing this long enough to know, I've been doing long enough to know, this always, this does come up. We'll take over clients that they're like, yeah, we went 10 years without raising our assessment.
Like ridiculous amounts of time. Yeah.
And I don't know anything that an association's responsible for that doesn't have some type of nominal impact of increasing, your garbage, your power, your gas, your labor, like all of these things, for at least the last decade have seen increases year over year. So it's not necessarily a good thing for us to say like, oh, let's hold on to this and not increase assessments.
And our general opinion is always it's better to increase it a little bit every year with a realistic budget than to, try and fool yourselves for a few years and keep things flat and then have a big jump, right? Like it's easier to increase an assessment by 4% than it is to keep it flat for 3 years and then jump 15 or 20% because, you know, the association's in the hole. So we were just talking with our director of marketing about a global newsletter that, you know, what do we need to put about budgets? Well, we should put in there that everyone should expect a small increase because that's usually what is going to happen.
Exactly.
Yeah. I mean, at a minimum, your reserve funding is going to go up every year, right? Your reserve contributions are.
Yeah, it should. I mean, unless you had like some endowment from your developer or like the person who started your community way in the beginning that like funded you for years to come, most communities are increasing their assessments, reserve assessment every year.
Yeah.
So, I think, you know, Eric kind of touched on this earlier, but the other piece of this too is sort of taking a look at that wish list or the things that the board, you know, wants to prioritize within the overall financial planning for the community. So are there things that would, you know, the owners have been asking for, like, hey, we've got this grass area, but it'd be really nice if we had some picnic tables or we had some barbecues out there, or, you know, those types of things. So those are things that to keep in mind this time of year is like, is there a way for us to work in some of these wish list items into the overall, and does it meet the financial obligations for the community?
And let your manager know. Let them know what you're thinking.
Because they, you know, a lot of times we may have had a community that's done a project like that. You know, at some point in time, we can put some rough numbers around that for you guys. Money we wish we had, right? We do have that conversation a little more often than we probably any of us would love to not have that a little bit more, but it is tough. It's a tough balance. So I think, you know, one of the things, if you've been a part of a board or a community for any period of time, then you know that all of these things are financial planning tools. All of these are maintenance planning tools. All of these things are definitely work that we try to put in to prevent, you know, sort of the unexpected. However, unexpected does happen. You know, snow's a good example in Central Oregon. We do our best guess and sort of best judgment based off of prior years and how many storms we have, and is it an El Nino or a La Nino year? And what do we expect from that perspective? What do you guys have on hand as retained earnings? Do we have enough of a cushion? But, you know, we can't necessarily always project those things. And so understand that there are some uncontrollable elements. As much as those are planning tools, there are some uncontrollable elements of that. And the managers, you know, will do their best to communicate those things to you as much as possible. So we've got a board member in the chat. Yes, Steve, who definitely are looking at.
So you know about this, Katie.
Yeah. Yeah, we have a few communities who are having some very tough conversations around their reserves this year, based on some updated reserves. And this happens when you've got communities who maybe have been self-performing reserve studies, and then you have an outside company that sort of updates those construction numbers. It gets, you know, it can get really hard that first year you get that information back as far as how do we jump that up and how do we get those expenses to where they need to be. So those can be really tricky conversations.
Yeah, we had an issue like this with a community that I took over a few years ago, where the reserve study that they had just had done that they provided to us during the transition said that they needed to have like $150,000 special assessments for the next 4 years, in addition to increasing the reserve contributions to get to the funding level where, you know, they were safe. So in that instance, we took that, we went through every component that reserve study had. We had a few professionals examine a few of those elements. we were able to push some of those useful lives out for some stuff that we knew was going to last longer. We were able to eliminate some things that weren't part of the association anymore because it had changed business models. And we were able to come up with like a 5-year kind of step up funding plan that was going to get them to that level with higher increases to the reserve contributions every year without a special assessment. But of course, working with your reserve study specialist and your manager and the board, maybe you do want to take a different approach. I've also managed a client where they just said, we're short and we're going to get $3,000 from everyone. And it's going to get us exactly to where we need to be for the reserves. And we're just going to have to explain to the membership that, if we're going to, keep the building safe and replace things that need to be replaced, like this is the step that we need to take. So those can be tough conversations though.
Yeah. Increasing assessments is never, and they're tricky things to navigate too. As I mentioned earlier, there could be some things in your documents that prevent a certain amount of increase or a certain amount of decrease. Sometimes if you are lowering your reserves or eliminating things or changing the way you've been reserving, sometimes that requires a vote of the owners. So it's always important to understand that element of it too.
I think most often I see like 10 or 15%. Like a board can't special assess without approval of, over 15% of their gross expenses for a year, or, can't raise assessments more than 10% from the previous year, something like that without owner approval. But of course, that's all going to be laid out in your docs.
Yeah. Yeah. And we've got a handful, I think, that some of them are at 20%, but yeah, definitely. So now is the time, for those of you that are on the line, if you want to turn your cameras on and unmute and you have any questions for Erik and I, you can also use the chat to put any questions that you might have in there. Again, if it's really specific to your community, Erik and I might not know your documents or, might not know the specifics of your budget, but we can certainly note the question and have your manager follow up with you. But if there are questions, we'd love to take them now.
Hey, we did good.
We did good. Well, thank you so much.
Actually, I'm typing a question I have. It's more of a suggestion. So it relates to the fact that rather than amortizing an expense for the same amount for the whole year, you actually have it budgeted in the month that it will occur. And one thing that in past life, I was always helpful to me in looking at budgets is, especially when you're looking at the monthly budgets, a recap, you have year to date. But if you're in the middle of the year, is it possible to get a line that has a projected close for that budget line? Because that's really the number we're chasing.
And yeah, where is it going to land? Yeah. And we are, Michael, we are working with our managers this year to really make sure that we're trying to seasonalize those numbers, that we're not just taking that 12-month number and dividing it by 12, but we are really plugging it into the months that we're going to see the expenses, so that that budget comparison report that you then get out of our system is more relevant. So we are working with the managers to make sure we're doing those calculations on a per month basis and not, as you said, amortize it over 12 months.
No. I understand that, but what I'm asking for or suggesting is that when we get the income statement, for example, let's just say July, it'll have year to date what it is, and it has, in some cases it'll have the budget for the year, but I'd like to know what the projected close for that line will be. So
that line will be, yeah.
So like if you're really over or under budget on something, is it expected to carry through to the end of the year, or,
just
that kind of question?
If you say, I'm just making this up, that maintenance is $20,000, we're halfway through the year, we spent $10,000, the projected close for that line based on what we know is $20,000, not necessarily what the budget is, but where we think things will close, happen, or expected to happen.
I know that's not something that everyone outlines on their reports to the board when they do the financial reports, but I know that we do try and highlight all the significant variances and explain why they exist and if we expect them to
I'm
be.
just, I spent, 40 years in business, and that was always, doesn't matter where you are, it's where you projected
Right.
you're going to end up.
Well, and it's a good suggestion, Michael. I think we'll pass it on to our accounting team too, because we're in the process of we're in the process of a new accounting system, and so we've got some feedback into the team on reports. So it's a good suggestion. I don't know if that structurally can happen, but yeah, thank you for the suggestion on it. We'll pass it on to the team.
Okay.
Any other questions?
Yeah, Katie, I had a question. I'd be interested in what strategies have you adopted for provisioning for the unplanned expense? Like the crunch storm that comes in, and suddenly you have to spend $20,000 cleaning up fallen trees or whatever. How do you make provision for that?
So I think both of those things, Mark, are generally handled either through retained earnings or through your reserve planning. And so if it's something that happens frequently enough, so like, for example, some of our boards will create, or some of our communities will create sort of a retained earnings account for, say, snow, where here in Central Oregon, we might have a really big event every 5 years, but we keep the budget flat. And if it's not spent, it sort of rolls into retained earnings. So you can use that through your operating and sort of roll that retained earnings into a specific fund that deals with those types of things. Or you can do that through your reserves as well. So we can add, line items into your reserves. Say every 3 years, it gives you a small pot of money to deal with those types of scenarios. If it doesn't happen, you're sort of cash positive then in that planning. But there's two different approaches that we've seen communities do. There's not a right or wrong way to do it, but it's, sort of documenting that on either side of the operating or the reserves as to how we're executing it.
Well, and also you can have in your reserve study, depending on what the unexpected thing that happens is you reserve for an insurance deductible. Every other year you reserve $10,000 for insurance deductible. So if you do have $40,000, $20,000, whatever it is, damage from some unexpected storm, and there's property insurance for that, you've budgeted in your reserves or even operating to have money to pay that deductible to get that, whatever it is, cleaned up.
Yeah.
Well, I guess what I was thinking about is in the case of a snowstorm, or in case of just a winter storm that brings down a lot of trees, that as long as it didn't hit anything, I mean, it would appear to me it would be more kind of an operational expense rather than a replacement reserve expense. And so but anyway, what you're saying, Katie, is basically you can make a provision for it, and either you roll it forward or you put it into a contingency fund that will cover these things.
Correct. Yeah. Okay. And for you guys, that's a little bit more manageable, Mark, because we've got staff on the property that can, respond. The tricky part comes if it's a really large storm and we have to deploy, a vendor in to sort of help come alongside the staff to get that property open or, to get things done, then that's what we have to plan for. But we can play around with some of those in the expense, depending upon which direction they want to go. But I can make that suggestion.
Okay. Thank you.
So Jessica, our marketing team will be sending you guys a follow-up email providing you with the slides today. So hopefully I should have said that in the beginning. So if you felt like you needed to take pictures of anything, she's going to be sharing the slides with you. And we'll keep you apprised of future trainings that we have coming up. If there's any questions that come up later when you're thinking, feel free to follow up with your manager and they can kind of route it to Erik and I. We're happy to help address them. And thank you guys for your time.
Thank you, everybody. Thank you for your time.
Thanks very much.
All right. Bye-bye.